Welcome back to the deep dive. So imagine this. You've been in front of your screens all morning and, things are just drifting sideways. Nothing's really happening.
Classic lull.
Exactly. You
Yeah.
step away for lunch, maybe you check your feed 20 minutes later, and bam, the S&P 500 has suddenly tacked on a massive 1% surge right into the closing bell. It feels like it came from nowhere.
It really does. And if you're only watching the traditional things, news flow, earnings reports, long-term fund movements, it is inexplicable.
Right.
But these sudden aggressive price moves, these flash rallies, they are the new signature of short-term technical forces, specifically from these extremely high-speed derivatives.
And that's our mission for this deep dive. We're going to pull back the curtain on this exact phenomenon. We're decoding what the street now calls a zero DTE options flow rally.
Mm-hmm.
We've got sources that detail the perfect storm of signals from one specific day, January 18th of this year, and we're going to show you exactly how to spot this market engine when it turns on.
But before we jump into the case study, we have to define the engine itself. So 0DTE. It just stands for 0 days to expiration options.
So contracts that expire the very same day.
The same day. They are the markets, I guess you could say, drag racing instruments. They have enormous leverage, and this is the key part. They require massive, instantaneous hedging from market makers.
Okay, so we're not talking about some big hedge fund making a slow, calculated move over weeks or something.
Not at all. This is capital that is deployed purely for intraday momentum. It's a completely different beast from, the fundamental buying or selling you see from long-term investors.
A different game entirely.
I like to think of long-term capital as a cargo ship. It's slow, it's heavy, but it's steady. 0DTE flow, that's a fighter jet.
You could accelerate violently.
Violently, but only for a very short burst. And the signature we're hunting for is that violence. It's that sudden, aggressive move that's just dramatically faster than the market's normal speed.
Let's talk about that speed for a second, because if the market is just slowly grinding up, well, that could be normal demand, right? We're looking for something that looks, as you said, almost unnatural.
Unnatural is the perfect word. When traditional asset managers are accumulating, you get a gentle slope on the chart. But when you have billions being deployed in instruments that expire in, say, 3 hours,
The move has to be vertical.
it has to be. It's an urgency signal. It's a fire drill.
Okay, so here's where we get to our case study, our visualization of this. The rally on January 18th, 2024. What did the market look like just before this thing kicked off?
It was completely asleep, drifting post-lunch, super low volatility, a classic midday lull. If you just looked at the price action around, say, 12:30 p.m., you'd think the day was going to end flat.
But our sources show that the clock hit a very specific time and the whole character of the market just flipped.
It did. The change started to register right around 1:00 p.m., and it really accelerated into 2:00 p.m. Eastern. That's when the quiet market suddenly broke into a full sprint.
Now, if you only saw the price move, just the S&P ticking up, you'd be guessing. Was Oops headlines, some Fed announcement?
And that's the trap. Relying just on price is, well, it's often misleading. To see the cause, you have to look at the machinery behind the curtain.
Which brings us to this tool that analysts use. We're going to refer to a specific metric here as the Teal Line.
That's right. This Teal Line is basically a sophisticated filter. Its job is to isolate and track only that 0-day options flow. It strips out all the noise from the big, slow institutions.
So you can see the real-time pressure from just these 0DTE instruments.
Exactly. It's tracking something called gamma flow.
Gamma flow. Okay, for our listeners who might know options but maybe not this deep, can you break down why gamma is the driver here?
Sure. So gamma, it just measures how quickly an option's exposure to the underlying stock or index changes. With 0DTEs, that gamma exposure is massive. It's incredibly volatile.
And that matters to the market makers who sell the options.
It matters everything to them. If they sell these high gamma calls, they have to instantly go out and buy the S&P 500 to keep their books neutral. And when you have billions of dollars in calls being bought, that forces the market makers to buy billions in the index.
And that forced buying is what actually moves the price.
That's the engine. That's what drives the rally.
So what did this Teal Line do during that 1:00 p.m. window on January 18th?
It was undeniable. The Teal Line didn't just move up a little bit. It went absolutely vertical, like a rocket launch on the chart.
Yeah.
And this massive vertical spike in flow, I mean, the aggressive buying of 0DTE calls, it happened in perfect instantaneous sync with the S&P 500 price.
So they move together in lockstep.
Perfectly. And that lockstep movement is the primary visual proof. It shows you the options market was driving the bus, not fundamentals.
Hold on, though. If the market was quiet, couldn't this just be one big institution making a regular trade? How do we know it was 0 DTE specific?
That's a great question, a crucial distinction. We know because of the Teal Line filter itself, it's designed to isolate only those instruments, but also, and more importantly, the speed.
Right, the speed again.
A traditional block trade moves price over minutes, maybe even hours. This move was consolidated into a single aggressive hour. That screams time sensitivity. Nobody buys a 3-month option that aggressively.
That synchronicity, that speed, it's compelling. But we always look for confirmation. We need to talk about the sheer scale of the force being deployed here.
Exactly. And the confirmation came at the same time from the NDX, the Nasdaq 100 index. While the S&P was surging, the Nasdaq data showed us who was fueling the fire.
And who was it?
A call sweeper.
A call sweeper. That sounds like a technical term for someone trying to hide their tracks. What does that actually look like?
It's basically a massive algorithmic buyer. They're trying to accumulate a huge position very quickly without tipping off the market, which would, instantly drive the price up against them.
And how do they do it?
The execution method was fascinating. It was highly automated. The algorithm was just constantly executing one-lot orders, the smallest possible size, over and over again, thousands and thousands of times.
So instead of one huge $10 million order that everyone sees, they're placing millions of tiny micro orders, just sweeping up every available call option.
It's machine versus market. It's stealth and volume combined. And this is how you can deploy immense capital, just incredibly rapidly and discreetly.
So what was the scale? How much are we talking about?
The scale was breathtaking. That algorithmic buyer, that call sweeper operating in the Nasdaq, totaled nearly $4 billion in notional value.
$4 billion in that short window.
In that short window, just on those short-term calls.
Wow. To put that in perspective, that's more than some sovereign wealth funds might deploy in a whole month. So let's connect the final dots for everyone listening. What happens when this $4 billion tsunami meets the forced hedging from the market makers?
Well, the dots connect in a straight line, the vertical spike in the 0 DTE Teal Line. That was the signal.
The pressure building.
The confirmation was that $4 billion systematic buyer in the Nasdaq. And that flow forced the market makers to buy and buy and buy the underlying indices to hedge.
Which in turn drove the S&P 500 up.
Sharply upward. And the result on the chart, the thing you see at the end of the day, the S&P 500 rallied roughly 1% into the closers.
And the key insight is that the entire move can be traced back to this one source.
We can demonstrably prove it. The whole 1% move was a function of this short-term options flow. It wasn't about a sudden belief in the economy. It was just technical mechanics overpowering everything else for a short time.
So for our listeners, how do we turn this into a usable lesson? How does this change how we should view a rapid midday rally?
I think the best way to think about it is the turbo boost analogy. When that teal line, that 0 DTE flow, spikes aggressively in the middle of the day, it's like a temporary burst of speed for the market.
The turbo is engaged.
The turbo is engaged, and the rally is fueled by maximum short-term thrust. You can ride that wave, but you absolutely must know what kind of fuel you're running on.
And anytime you talk about a powerful but temporary boost, there has to be a word of caution. If this is all driven by $4 billion in short-term leverage, that power source has to be inherently unstable, right?
That is the single most critical caveat. These 0 DTE-driven rallies, they often have almost zero stability for the next day, and we need to understand why.
Why is that? I mean, if the index is up 1% at the close, shouldn't that be the new floor, the new level of support?
That's what you'd think, but this is where the technicals hit a reset button. Remember, the market makers were forced to buy the index all afternoon.
Right, to hedge those calls they sold.
Exactly. They were holding index futures, holding shares, just to stay neutral until 4 p.m. But what happens at 4 o'clock?
The options expire.
They expire. And all of that hedge, all those shares they were forced to buy, is suddenly unneeded. The technical reason for holding them vanishes. Instantly.
So the market maker is left with this huge pile of long inventory that was only there to offset the options that are now gone.
That's the entire story. And that inventory is a huge potential pool of selling pressure waiting for the next morning. The underlying technical force that created the momentum is just removed.
The turbo boost is gone.
The fuel tank is empty. A true fundamental rally is fueled by capital that stays put overnight. A 0 DTE rally is powered by technical forces that just disappear at the closing bell. And that difference in stability is everything when you're planning for the next day.
Okay, that makes it crystal clear. We started this deep dive looking at those aggressive rallies that seem to come from nowhere, and I think we've solved the mystery. We know the setup, a quiet market goes vertical.
And we know the signal, that vertical spike in the filtered 0 DTE flow, the Teal Line.
And we confirm the magnitude with the evidence of that $4 billion call sweeper. The value here for you listening is you can actually start to tell the difference between a market building real strength versus one that's just on a technical sugar rush.
A sugar rush that is very likely to be unstable the following day. It changes how you see that 1% gain. It's not conviction, it's a side effect of a hedging cycle.
So we'll leave you with this final provocative thought to consider. If a $4 billion options flow expires at the end of the day, leaving the market 1% higher, what does that really imply about the stability of that trend the next morning?
What happens when the market opens without its turbo boost?
Something to think about. Thank you for joining us for this deep dive. We encourage you to start looking beyond just the closing price and instead explore the indicators that reveal the hidden forces moving the market.
Always look at the plumbing, not just the water coming out of the tap.
We'll catch you next time.